Welcome to Deep Dive into Finance channel, where we bring complex financial concepts to your fingertips. Today, we're going to take a closer look at two key aspects of finance and investing that are essential for making sound financial decisions: entry and exit strategies. Have you ever wondered how seasoned investors always seem to know the right time to buy or sell? Well, it's not magic, it's strategy. Entry and exit strategies are the backbone of successful investing. They help investors determine the optimal time to enter or exit a market, thereby maximizing their returns and minimizing their risk. But like all tools, they're not foolproof. They have their pros, they have their cons, and it's crucial to understand both sides of the coin. So, whether you're a beginner dipping your toes into the investment pool or an experienced shark looking for new insights, we've got you covered. Stay tuned as we delve deeper into these concepts and help you navigate the world of finance with ease. Starting off with the entry strategy, it is a plan that an investor uses to enter the market with a specific investment. It's like the first step in a dance, setting the tone for the rest of the performance. But what makes a good entry strategy? Well, it's not a one-size-fits-all answer. It's determined by a few key factors. Firstly, timing is everything. It's about knowing when to step into the market. For instance, buying when prices are low and selling when prices are high is a common strategy. But it's not just about the price, it's also about the timing in relation to market conditions. Which brings us to our second factor: market conditions. Understanding the overall state of the market, whether it's bullish or bearish, volatile or stable, can greatly influence your entry strategy. For instance, in a bullish market, you might want to enter earlier to ride the wave of increasing prices. Conversely, in a bearish market, it might be better to wait until prices have bottomed out. Thirdly, your financial goals play a crucial role. Are you investing for short-term gains or long-term growth? The answer can significantly affect your entry strategy. For example, a short-term investor might look for quick opportunities, while a long-term investor might be more concerned with steady growth over time. A well-planned entry strategy can be the key to successful investments. It's like a roadmap, guiding you through the unpredictable terrain of the financial market. It helps you make informed decisions rather than being swayed by emotions or impulse. But remember, even the best entry strategy is not a guarantee of success. It's simply a tool to increase your chances of making profitable investments. It requires careful planning, thorough research, and continual adjustments based on market changes. A strategic entry can set the stage for potential success, but it doesn't end there. The exit strategy plays an equally important role. An exit strategy, on the other hand, is a plan to sell an investment when certain conditions are met. This is where we must be shrewd and vigilant, keeping a keen eye on various factors that can influence a beneficial exit strategy. The first key factor is the market trends. Much like an ocean's tides, markets ebb and flow. Recognizing these trends is crucial. A rising market trend could mean it's time to sell and reap the benefits of your investment. Conversely, a falling trend might signal a need to hold on, weather the storm, and wait for better conditions. Next, we have investment performance. This is a direct reflection of how well your investment is doing. If it's consistently performing well, you may be tempted to hold on to it, but remember, the goal is not to fall in love with your investments. If you've reached your financial target, it might be time to say goodbye and sell. Changes in financial goals also play a significant role. Life is unpredictable, and so are our financial needs. You might have initially invested with a 10-year plan in mind, but a sudden change in your financial situation could necessitate an earlier exit. It's essential to have a flexible exit strategy that can adapt to these changes. Now let's focus on the role of an exit strategy. Its primary function is to protect your profits and minimize losses. It's like your investment's bodyguard, ensuring the fruits of your labor are safe and secure. A well-planned exit strategy can help you navigate the tumultuous waters of the market, providing a safe harbor when needed. Just as a gardener knows when it's the best time to harvest their crops, a smart investor knows when it's time to exit an investment. It's not merely about making money, it's about preserving and growing wealth strategically. While an entry strategy sets you up for potential success, an exit strategy ensures you secure it. So make sure you've got your exit strategy mapped out. After all, your financial success is worth the effort. You might be wondering, why are these strategies so crucial in finance and investing? Well, let's dive deeper. Consider the entry and exit strategies as your roadmap in the vast world of investing. Without a roadmap, it's easy to lose your way. And in terms of investing, losing your way could mean losing your hard-earned money. One of the key benefits of having a solid entry strategy is risk management. It allows you to identify the right time to invest in a particular asset and at what price. By doing this, you can minimize your exposure to market volatility and reduce potential losses. On the other hand, an exit strategy serves as your safety net. It determines when and at what price you should sell your investment to secure profits or cut losses. Think of it as your game plan to protect your gains from being wiped out by sudden market downturns. Together, these strategies help in profit maximization. By knowing when to enter and exit the market, you can optimize your investment returns. But remember, investing is not just about making profits, but also about preserving your capital. Now, what happens if you don't have these strategies in place? Well, you're basically investing blindfolded. You might get lucky once or twice, but without a clear strategy, your investment decisions would be driven by emotions rather than rational thinking. This could lead to poor decision-making, such as buying high out of fear of missing out or selling low due to panic selling. Moreover, without these strategies, you're putting your financial stability at risk. Investing by nature involves risks, but by not having a clear entry and exit strategy, you're unnecessarily amplifying these risks. In conclusion, these strategies are your guiding lights in the often unpredictable world of investing. They provide you with a structured approach to making investment decisions, helping you to navigate market volatility and safeguard your financial future. As you can see, these strategies are not just optional tools, but necessary components of a successful investment plan. Now that we understand these concepts, how do we apply them in real-world investing? A good place to start is by setting clear financial goals. Knowing what you want to achieve, whether it's growing your wealth over the long term, generating income, or preserving your capital, will guide your decision-making process when it comes to choosing when to enter and exit a position. Next, you'll want to do your homework. This means researching the asset you're considering, understanding its market dynamics, and staying informed about broader economic trends. You wouldn't jump into a swimming pool without checking the water's depth first, right? Similarly, you shouldn't dive into an investment without first understanding the lay of the land. Once you've done your research, it's time to decide on your entry point. This is where your analysis will come into play. You'll want to look for a price that offers a good balance of risk and potential reward, based on your assessment of the asset's value and market conditions. But remember, the work doesn't stop once you've entered a position. It's important to monitor your investment and the market continuously. This will allow you to spot any changes that might signal it's time to exit. Keep an eye on the price, but also pay attention to any news or events that could impact the asset's value. Finally, remember that no strategy is set in stone. The financial markets are dynamic and unpredictable. This means you'll need to be flexible and willing to adapt your strategy based on changing conditions. It's a bit like sailing. You can't control the wind, but you can adjust your sails. In conclusion, developing and implementing effective entry and exit strategies requires careful planning, continuous learning, and a willingness to adapt. It's an ongoing process, but one that can help you navigate the financial markets with greater confidence. Remember, the best strategy is one that aligns with your financial goals and risk tolerance. In conclusion, entry and exit strategies are essential tools in the world of finance and investing. We've explored how these strategies work, their significance, and their practical applications. An entry strategy, as we've seen, is your game plan for buying assets at the most opportune time. On the other hand, an exit strategy outlines how to sell these assets effectively to maximize profits or minimize losses. These strategies aren't one-size-fits-all. They require careful consideration of your financial goals, market conditions, and risk tolerance. It's crucial to tailor them to your unique circumstances and adjust them as necessary. Don't hesitate to seek professional advice if needed. Investing can be a complex journey, but with strategic planning and a clear understanding of these concepts, you can navigate the financial seas with more confidence. Thank you for joining us on this financial deep dive. Stay tuned for more insights on the fascinating world of finance.